Hello everyone, it's time for the quarterly market talk. If Q4 2019 had a theme, it might be soaring to new heights. In the latest issue of our quarterly market talk report, we'll examine the factors that pushed markets to new highs in the last quarter of the decade. We'll also explore why the markets love the trade talks between the US and China, how holiday spending impacted the economy, why the Fed decided not to lower interest rates for a fourth time in 2019. Happy New Year. I'm Noah McIntosh with McIntosh & Associates, and I'd like to take a few minutes to cover the last quarter of 2019. The fourth quarter built on strength we saw in September, and it was really at full speed ahead when we hit new highs over and over again to close out the year. The drivers in the quarter were the same ones we've been dealing with all year. China trade talks, USMCA, the Fed, and political turmoil in Washington. This time around, the wind was mostly at our back. China returned to the table and when the quarter was over, had committed to an initial agreement on trade called Phase 1. The additional tariffs scheduled to take effect in mid-December were suspended, but current tariffs remain in place to ensure compliance. Nothing new, in my view, has been resolved in the China other than agreeing to buy more agricultural products from us. I still think most difficult discussions lay ahead. Forced technology transfers, intellectual property theft, currency manipulation, and government subsidies to Chinese businesses, etc., etc. My guess is the Chinese will never give in on these issues, and Phase 1 is probably all we'll ever see. But in the fourth quarter, the markets loved Phase 1, and at least for now, the trade war tensions took a backseat to strong economic data. Speaking of economic data, the consumers showed up strong for the holiday season. Confidence was up and unemployment continued to hover at 50-year lows. Wages have started going up while gas prices have been slipping lower. Combining all of these factors was just the potion the market needed to push higher as we headed into the end of the year. The S&P was up nearly 30% for the year, and the NASDAQ crossed above 9,000 for the first time. Remember the NASDAQ 5,000? It took 15 years to get back to 5,000 after the tech bubble burst, and now we're on the verge of doubling that. The Dow returned 22% on the year, and that was primarily from the drag that Boeing and the 737 MAX were responsible for. The Fed, after lowering 3 times in 2019, signaled that it would take a step back and continue to monitor conditions as we moved into 2020. The November jobs number was tremendous and dispelled any notion that the economy was in any kind of trouble. The 10-year Treasury was just back under 2%, and all that yield curve inversion chatter disappeared as it became abundantly clear that the economy was sound. The passage of the USMCA will also have the economy going forward. The growth had slowed, but we were still solid and nowhere near heading into a recession. Overseas, we saw some certainty between Boris Johnson in the UK won a decisive runoff election, and it appears now that Brexit is a certainty. I'm not sure if they will meet their January 31st deadline, but Brexit will finally happen. Worldwide, economies seem to have stabilized, although not super healthy, at least by our terms. They're not declining any further. I'm still on the fence on whether it's time for international investments right now because it's just too hard to justify allocating away from the US when you juxtapose just how strong we are with the rest of the world. Staying overseas, we had the usual smattering of international headlines, and whether it was protests and riots in Hong Kong and Iran to the Christmas surprise from North Korea that never materialized. Markets took international geopolitical turmoil in stride as they continued to march upward to close out the year. And finally, I'd almost forgotten. The House of Representatives have issued and voted on 2 articles of impeachment. As of this recording, they have yet to transmit those articles to the Senate in order for the Senate to conduct a trial. Markets did not see anything new in the proceedings, and as I've been saying all along, markets just don't care about impeachment since they also realize the president will not be removed from office, and the process is viewed with skepticism as being highly political from both sides of the political spectrum. The public seems disinterested as well, and people were also distracted by the holidays to pay too much attention. I'm sure things will ramp up on the impeachment front in the new year, which they have, and provide a lot of entertainment and speculation on where we go next. But the last quarter, impeachment was not a major issue as far as the market was concerned. All in all, we had a strong fourth quarter and an impressive 2019 in the markets. There were plenty of twists and turns along the way, but 2019 bore out the old adage that staying invested in the long run is the best way to go. It was very tempting to walk away after the fourth quarter of 2018, but if you stayed disciplined and focused, you were rewarded in 2019. Thank you and have a safe and prosperous new year, and we'll speak again soon. Obviously, if you have any questions about how recent market activity has affected your investments, please call us at 989-692-2200, and we're always here to walk you through what's happening in the market and what it may mean for you. Have a great day. We'll talk to you soon.